Hey, welcome back. This is Matt, the Helpful Home Inspector, coming at you live from our studio up in Hartford, Wisconsin. We got a great show for you today. We're going to be talking about all kinds of interesting things to help you better maintain and take care of your home, and today, improve your life a little bit. I have my good friend Bill Moeller here from Bank 59 or Bank High Five. Now, the next thing we want to talk about is understanding a little bit about how these products are paid off. Okay, so a HELOC, we talked about, is you're paying a minimum payment based on the interest of the amount that you have been using.
Interest drawn.
Yep. And then when you're talking about a cash out refi, you're just paying it like your regular mortgage. So there's two different ways of paying
so
that
think
back.
of it like we got in the Uber and the meter started running.
Yep.
And so basically, from a cost of funds standpoint, similar to a credit card, you're going to make a minimum payment based on the interest that accrued per day. Mm-hmm. So what we would do is we would take the loan amount times the percentage of interest and divide it by 12 to get the monthly amount.
Yep.
That's that example I gave you earlier where if I had $10,000 and it was 6% interest type of thing. And then whereas with a 30-year amortization, or if I did 15 or 20 year, we're going to be in a situation there where we're going to put all those numbers side by side on a spreadsheet again. Yeah. And we're going to evaluate it because there's another, as there is with everything, there can be a trap for a lot of different factors. And that one thing I always tell people is don't get a home equity line of credit. If you're in your subconscious mind, you say you're going to make, I'm going to pay extra every month.
Yeah.
I promise, Mr. Loan Officer. And then in reality, all you do is make a minimum payment.
Make the minimum payment they require of you.
Because then the drop period ends after 10 years.
And you're stuck with having to pay that back.
And now your equity is tied up. Whatever you put on there is tied up. So you have to really be conscious about what you're going to do with it.
Yeah. And after that 10-year period, let's say you have $80,000 still on the HELOC. What happens to it?
Depends on the lender. For a lot of lenders, they're going to switch you to a principal and interest payment because they don't want you to keep kicking the can down the road.
Yeah, basically an amortization schedule.
Mm-hmm.
Yeah, so that eventually draws automatically.
Otherwise, you got to refinance it.
Yeah, yeah. And then as far as the cash out refis, that's just your regular mortgage payment. It would just change because whatever your mortgage payment was on a different loan product, obviously, and at a different interest rate. And it may have been that you had a $300,000 loan, and now it's only a $250,000 loan. So maybe your mortgage payment goes down, but it's at a longer term, but it all is relative to what you choose. So if you choose to go into a 10-year repayment plan versus a 15 or whatever, that's going to affect the interest rates and things like that.
Yeah, and we have situations too where people get closer to retirement, but they're in this tough spot because they really worked hard to knuckle down and get their debt paid off. And then they all of a sudden fall into a situation where they have some medical expenses, or they accrued some credit card debt, or they had car repairs, or whatever the case may be.
Shit happens, right?
They go and get a 10-year fixed rate mortgage from us. We'll portfolio it. We'll give you a nice low fixed rate, and we can help people get into a situation where they can free up some of that capital out of the equity to do what they need with it.
And it's a tax write-off then at this point.
Absolutely.
If they don't change that.
Depending on, a lot of things that factor into the standardized deductions and stuff like that. Talk to your CPA.
Yep.
There's a chance that it could be a tax benefit too.
Could be. Yeah, for sure. But that is a HELOCs and cash out refis. I think we covered that pretty thoroughly.
Yeah, I'd say we should.
It gives you a good idea.
We should. Do you think maybe we could show that Mortgage Coach spreadsheet?
Oh,
quick?
Yeah. So the Mortgage Coach spreadsheet is a tool that Bill has that he can go through with you. You just have to get a hold of him. But this is kind of how it goes. Give him the down low, man.
Yeah. So total cost analysis is a tool that I've been using for over 10 years. And a great guy by the name of Dave Savage in California, who is a pioneer in the mortgage industry, came out with this program where, as a mortgage lender, we are basically debt managers. Mm-hmm. And, you can get a lot more sophisticated in the way that you approach your debt if you have someone that's going to be a debt manager versus someone that's just going to quote interest rates.
Yeah.
So our objective is plain and simple in a situation where if you're buying a house, we have to help you map out first of all, we're going to help you figure out what price point you should be looking at by showing you a range.
Yeah.
And then if you are in a situation like this particular client was, they closed on a house last December and their interest rate was 6.5%. And I gave them a very low closing cost option to get into a 15-year fixed, and I showed them how much they were going to save in interest.
Yeah.
So this type of tool, because we're licensed through the majority of the nation, we help people evaluate with these kind of tools. And the thing that your elder parent or your someone who basically doesn't really do the due diligence says is that you always need to save 1% on your interest rate. Have you ever heard that?
I've heard that. Yep.
Yeah, you got to save 1% on the rate.
Pay 20% down. That was old wives' tale stuff. But
yep.
Yeah.
So in this particular instance, this customer took a loan that was for $175,000. And they wanted to pay it on a 15 because I always ask people, how long are you going to stay in your house and when do you want to retire? Mm-hmm. And I also help them look at their debt to income ratio. Well, this particular customer had a $335 increase, but in 5 years' time, they saved $10,000. And in 7 years' time, they also looked at how much their total sum of their payments was going to be and how much they were going to save. So we're using tools that we can forecast out for people the idea of how much equity you're going to have in the property.
And see the dollars.
And actually see it. Because if you don't use a tool like this to help someone evaluate their financial plan, honestly, the customer is left in a little bit in the dark. And you can even see in here, we even have a tab for closing costs. We do a screen share, we do a Google video meeting, or we'll meet with you live and go over it.
Yeah, that's great. And we will, in the replay, we'll flag Bill's information in here, but we also have Bill's information up on our website, thehelpofhomelesspatriot.com. You can go out there and get his contact information, email, phone number, all that kind of jazz or whatever. Another great resource. But you need somebody to lead you through that process. Just plugging in numbers in the balance sheet that we looked at before is simple enough to do on your own, but this is more than that. This is something where you need somebody to help you interpret those numbers.
Absolutely. It was, I always like to say it was your best thinking that got you to this point. Yeah. Just like no different than I go talk to my financial planner. If I have a technical question about my house, I talk to you.
Yeah.
You know, everybody thinks that advice from Google is great, but in reality, it's not great if you don't really know how to interpret it properly.
And Bill, how much does it cost to talk to you about mortgages?
It's pro bono work.
Pro bono.
Yeah.
All right. So Bill works for... Yeah. He doesn't work for free. He gets paid.
I'm compensated if I go to a closing.
Yeah, if he makes it to a closing, that's where he gets compensated. But ultimately, Bill would be happy to talk to you. You don't have to make any payments or anything like that. But I would almost guarantee you that you're going to learn something from him when you sit down to talk to him. And with all likelihood, he's going to be able to find some ways to save you some cash. Hey, thanks for tuning in today, you guys. If you like this video, please give us a thumbs up. If you want to know when we put out the next one, give me a bell notification. It's a little bell on the bottom right-hand side. And subscribe. You want to know when I'm coming out with new stuff or whatever. You want to be able to check us out and be alerted to new video content coming your way. Subscribe button's really the way to go. Thanks again for tuning in, you guys. Remember, the better you take care of your house, better it's going to take care of you. Have a good one.